Thank you all so much for coming out to the BevNet West Coast branch here in San Diego. My name is Ray Latif. I'm the editor and producer of BevNet's Taste Radio podcast. If you're not familiar with the Taste Radio podcast, we are the #1 show for anyone building a business in food or beverage. If you're looking to start from the ground up or help scale your business, we have the answer, speaking to founders who have been there, done that. And that includes folks like this gentleman next to me. That's Jeff Church, who is the co-founder and former CEO of a little brand you might have heard of called Suja. Jeff, thanks so much for being with us today.
Thanks so much, Ray. Hey, everybody.
Yes.
Happy to see everybody.
You can clap. Jeff Church is a legend. You should be clapping.
Just old.
No, not at all. So we are recording in front of a live audience here. We're going to post this content on the podcast on Taste Radio a little bit further down the line. So please, no screaming and yelling. Unless you're screaming, listen to more Taste Radio because that always helps, doesn't it? I think so. Anywho, as I mentioned, Jeff is the co-founder and former CEO of Suja, but you've been involved in the beverage industry for a long time. Talk a bit about your background.
Yeah, thanks, Ray, and welcome, everyone. Happy to see everyone here. Is Jimbo here by chance? Oh, thank God. I hope you block him. Please block him at the next time at membership. We just need to keep that kind of riffraff out of here. But, okay, if you happen to see him, please don't tell me. Thanks, Ray. I've been in the beverage space for about 15, 18 years. I've been in the business space, buying or starting businesses for the past 35 years. I guess over that period of time, I've had 8 companies of my own, 5 of which were companies I acquired and used the assets of the business to fund the purchase price, and then built them up over time and sold them. And then 3 of them have been startups that I've done all in the food and beverage space over the last 12, 14 years. So I like the startups a lot more because they're just fun. I mean, I say fun. You guys are like, fun? Really? We're having fun? It's fun because of the freedom that you get, the esprit de corps that you get to create. I feel a lot like, as a founder, I'm an artist and I'm painting a portrait and I get to paint the culture of the company. And when you buy a company, you don't get to paint that. You inherit a culture based on what you get. You can kind of move it on the margins, but you can't really change it the way that maybe you'd want to have it. So the startups are really nice because you get to create, you're your own artist and you get to create that portrait the way you want to create it. And you only have yourself to blame. So that's the only negative about it. Can't blame somebody else.
Yeah. I do want to talk about Suja. I do want to talk about Rowdy Energy. I want to talk about a few of the businesses you worked with. I do want to take a slightly different tack than we typically do on the podcast in that I want to kind of go backwards and start from the back and go forward here. People talk about startup life all the time, and there's a glamour to it. Obviously, there's a hardship to it as well. But, if, in your opinion, having been involved in so many, what's the most difficult part that people don't realize about startup life, especially in that 1 to 2 years in? Because once you're in the market, once you get the product out in the market, that seems like that's the easy part. Everything else is difficult. But what's the most difficult part in that 1 to 2 year stretch?
I think the most difficult part in the early stage is, you don't have that much revenue to start, right? And your gross margin isn't that high to begin with as a percentage, so your actual gross margin dollars aren't that high. And yet you've got these operating costs that you're trying to build a brand and build a business, and they're out of whack, which causes you to lose money. And I think the first couple of years, you're renting time, as I call it, and you feel like the clock is ticking, on you before you run out of money. And that's a very, that's a very destabilizing, thought to know that, okay, I'm now 1 month closer to my 18 months. Now I'm 5 months closer. Now I'm 7 months closer. Now I got to raise money, but maybe it doesn't look that great to raise money. So, I mean, that whole that early stage from that standpoint is very stressful. I think the first hires that you make are really, stressful hires because if you hire wrong in the very, very beginning, it's a real, kind of puts you back type move. I call them fatal flaws. But I think, the money side of it's really challenging, in the beginning and running out of money, not having enough money, and then, just continuing to, to build that out. I mean, it changes over time, but I think that for me is the most difficult part. I think also, as a founder, we have to be somewhat, risk tolerant, right? And we have to be somewhat comfortable with looking over the abyss, over the cliff and into the abyss. And we have to be somewhat comfortable with that. And that's a hard thing to do. Especially, I find it hard for a spouse, that isn't necessarily directly in control of the situation, to also do that. So for those of you that have spouses that are doing this kind of stuff, please communicate and over-communicate, with them, because, they don't have the control that you have, and, they're playing with you're playing with their life assets as well.
I mentioned the glamour that's associated with the food and beverage industry. It feels great to be able to say, I created this, and then go to a store and see it on shelf, and maybe have someone buy it off the shelf. You're like, this is crazy. I did this. At the same time, you're wondering how many more people are going to buy this. How do I get more people interested in seeing my product out there? And sometimes you get lucky. Sometimes you're just in the right place at the right time. And I'm not saying Suja was lucky, but Suja was definitely a brand at the right place in the right time. And I think your leadership helped the brand take advantage of that opportunity. When you do think about, finding yourself in a good situation where you do have the ability to scale quickly, or at least attract attention quickly, talk about that process. How do you start thinking about where is the first step? And then where is the next step? And how do you look 10 steps into the future? I mean, do you even do that?
Yeah, that's a really good question, Ray. I do. Whenever I start a business or acquire, a company, I call it begin with the end in mind. It's kind of a Stephen Covey concept, 7 Habits of Highly Effective People. And I'll actually write the selling memorandum when I'm doing the due diligence to buy the company or to start the company. So I'm kind of writing my strategic plan that I'm then working backwards on that plan and trying to see where I have holes, in that plan. So do I not have, a good route to market? Do I not have good intellectual property? Do I not have the right team? And I start to see the holes. And it's kind of like a 5-year process that I'm looking at it. So if you kind of start with where you want to get to, even with this revenue and your profits and all that kind of stuff, and then work backwards, you're able to kind of break down, where do I have the holes that I need to fill in here. In Suja's particular case, though, we were really lucky in that we were the number 3 cold press juice company to come out. I mean, there were some other little ones around the country, I'm sure, but we were behind Blueprint Cleanse and Evolution Fresh, and both those companies were running out of money right as the market was coming up. So they were just a little too early. And both those businesses, Evolution Fresh, as it turned out, didn't sell for more than $15 million to Starbucks. And had he been able to hold on another year or two, it would have been a wholly different, outcome. So a little bit is luck in terms of timing. Right as we were launching, both those brands were acquired by larger CPG brands. And, as you know well, Ray, but when bigger companies acquire little companies, oftentimes they lose that founder esprit de corps and that kind of, just that we're going to take the hill, we're going to win this game, we're not going to let anything get in our way. Just that fighting attitude, they kind of lose that. And both the parent companies that bought both those companies, one of them diverted HPP machines to Blueprint Cleanse to another one of their divisions outside of Blueprint Cleanse. Can you imagine how demoralizing that is to have that happen like right away? As you're partnering with someone. So, they both were acquired and they kind of went off the road. So all we had to do, and I won't say all because we grew from 0 to 100 million in 6 years, but all we had to do was kind of hold the stick in the middle of the road. And, actually execution is something you can control. Demand is much harder to control because you can say, well, I want more sales, and you can put the things in place to get them, but you may not get the sales. Whereas execution, you can control that. You can be very detail-oriented, and we were really, really detail-oriented. I would send literally half a pallet from San Diego to the East Coast for business in a full truck. As you can imagine what a disastrous idea that is from a profit standpoint. But I mean, I would do that because I was scared. I was petrified of the cold chain and breaking the cold chain and having, because you never know if it sits on a dock for a couple hours and starts heating up and the micros start growing because of that. You just don't know, and you'll know it in 2 months when you have product blowing up on people. But that's not a lot of fun either. So we just had to keep the stick in the middle of the road. Again, not easy, but easier than trying to get demand out of the thin air.
I want to go back to something you said about thinking about the end first. A lot of people here are like, you know what? I want to create a brand that is lasting, that has value generations after I'm done with it or I exit the business. And that's pretty ambitious. How do you factor ambition and the potential of a brand when you are mapping out that business strategy?
That's a good question. I wish I'd thought of that question. It wasn't on the questions we talked about, Ray. But, from a strategy standpoint, I mean, I'm just, it's how do we get up the hill fast enough, as fast as we can? How many people do I need to strap on my back to come up the hill with me? Who else can strap people on their back to come up the hill? I mean, it's literally just, and that's why the skill sets of an early stage founder are very, very different than the skill sets of a professional manager that comes in much later stage. Frankly, I find that really, really boring. In fact, you're doing pre-meetings, and I don't know, if I do another pre-meeting with Coca-Cola, I think I'll shoot myself in the head. But they do them, or take 12 people to a top-to-top, with a retailer when, you guys are probably used to taking yourself and maybe a salesperson or a marketing person. And I like that environment because that environment, you're very lateral in your thinking. You have to understand route to market. You have to understand, your marketing strategy. You have to understand, the distribution network. You have to just understand a lot. Where literally, I would show up at meetings with Coke and there'd be 12 people in a meeting for an hour with one buyer on the other side, and the salesperson actually didn't know how the product was getting to the customer. To me, that's not very much fun. So I like the earlier stages. I don't necessarily love, the fact of you're worrying about am I going to make it or not every day, every minute of every day, pretty much of your existence. But I find that's what's kind of worked for me is just frankly to outwork it a bit.
All right. Here is a question that was on our list of questions.
Thank you.
Okay.
Thank you. Let's get back to those, right?
In hindsight, when you think about Suja and the success that you had with the brand, in hindsight, what was the most impactful decision you made that helped the brand get to that point?
Oh, I'm glad you asked that question, Ray. The ability
do you want to pull out your cliff notes here?
Yeah. The ability to pivot, and I call it fake it till you make it. And these businesses are shit show businesses in the beginning.
This is, there's...
Yeah, I didn't. You had that in your notes.
Apple Podcast.
Use one profanity word. You said right.
Okay, I'm sorry to interrupt you.
but they're tough businesses, and where you start today, I guarantee you, 5 years from now, your business is going to look very, very different. And the top 10 SKUs that we had when we started Suja, only one of them is in the top 10 SKUs today. In fact, probably 7 of them aren't even in the portfolio. So, things change over time. And until you get to a place where you're operating at the median level of velocity in your set, or you're operating at a nice, ROAS on Amazon and those metrics are in your favor, you're kind of renting time, as I mentioned earlier. And I call it fake it until you make it. And you want to pivot. I mean, Silly Putty, that product that, we've all used a lot or your kids used a lot, started out as a wall cleaning product and turned into a, product that they realized they used it to clean marks off the wall, and they realized it could do a lot different. The things we start can be very different than where we end up. And I think it's just important to keep, innovating, keep being intellectually curious, keep pushing yourself out there until, you get to a spot where you've got a product that's actually really working. We launched at Suja a new product every 8 days over a 7 or 8 year period. And we killed a product every 14 days, which really upset our ops people because that difference really built this big surge of products that we were making 50 SKUs, every week. But, I think the pivoting is really important, the understanding that it's okay. Some people will say, people used to accuse me of churning, meaning that I keep just launching to launch and I got to let the cake bake in the oven. I agree that that's part of it, but until you're in a cash flow break-even spot, you're renting time. And, the longer you go without getting that profitability, the harder it is, to be there.
I saw one of the early Suja vets, Jessica Pratt. Did you dry heave when every 8 days a new product was?
No, she caused it. She caused it. She was on the cause side.
Well, we're gonna do an oral history of Suja at some point. Stay tuned for that, folks. I did mention a brand, Rowdy Energy. This is another brand that had a lot of potential.
I thought I said that one wasn't on the list.
Yeah, it seems to be on my list right now. No. We actually featured you and the founder, a very famous race car driver, Kyle Busch, on the podcast. Didn't work out as well as Suja. Talk about the history of that brand and sort of the biggest challenges and the reason why it just didn't work out the way you thought it would.
Yeah, I think there's a couple reasons it didn't work out. And believe me, that was a gut punch, because you kind of walk away after Suja and you think, hey, I'm doing pretty good at this. I've done this a couple times now. I've got some good track record. And then boom, we created a fantastic product in Rowdy, but we just couldn't get the sales. And we got the distribution, we got the doors, but we couldn't hold the shelf. And you want to talk about something painful, getting into 25,000 doors and then Chinese water torturing, door by door by door by door until you're down to 0 doors. Very, very painful process. A very difficult category. And someone very smart told me, don't go into energy drinks, Jeff, right before I went into energy drinks. And
I think that was me.
Yeah. And it's just people and I know people do it. I did it. So sometimes we have to learn, on our own. But, if you look at some of the categories that are the most competitive right now, like hydration and energy, they're very, very difficult to make it in because any kind of digital advertising you're doing is very expensive, or you've got to be really creative about how you're doing it because you can't buy, kind of keywords because they're just too expensive and they won't convert economically, for you. So you've got to be able to, adapt with all that stuff, and that's not easy to do. So, I think with Rowdy, I was invited to partner with a NASCAR driver, and I thought, okay, a celebrity is going to work. I didn't really realize that the celebrity that had contacted me happened to be also considered the bad boy of NASCAR. So we were launching a Better For You energy drink into the NASCAR environment, and I just don't think they cared about low sugar and all that. I got really good at learning all the drivers in NASCAR, if anybody wants any help with that afterwards. But we raised $25 million, lost it all. $3.5–4 million of my own money, lost it all. Very, very difficult. I think in the energy drink space, unless you can get the right celebrity that can really help you kind of rise above the clutter, or just get something that creates energy. You see it. They pop, Ghost popped, Alani Nu popped, some of the energy drink brands. But unless you pop or have some reason to pop, and most of those brands have come from the powder market, supplement market first through GNC and Vitamin Shop and places like that. So they already had kind of built up, followers. So they had the ability to pop. And I also think we didn't go DSD. We went broadliner, and they both have their challenges, as everybody knows. The OIs on KE and Unify aren't overly fun, right? But DSD, being in the back of the corner in the DSD store, is really not fun. So, it was challenging. I also think I got caught in the transition from a traditional, you got to get to a consumer 7 times before they actually will go into a store and pick up your product. That model changed much more to the influencer, social media platform type model, where it was about finding a trusted advisor that you would, follow. And that kind of disintermediated my 7-step idea. And I was late, I think, in trying to, see that. But, a really strong learning lesson, very humbling. But it happens. You're gonna strike out. These are challenging things to do. I think, you start a business, and what's the odds of early success? 20%, 30%, something like that. I feel like now, I used to feel like I could get a business maybe to 90, 95%, success. And then the last 5 or 10 was luck and opportunity and timing. Now I feel like it's more like 70, 75%. But that last 25%, if you don't get it on your side, it's a real strong headwind. And, starting a business, raising money, selling a business into what I refer to as headwinds, things that can be somewhat negative versus tailwinds that are pushing you, is always very, very challenging.
Well, I think you created a bunch of solidarity when you said that you raised a bunch of money, you lost a lot of personal money. I saw people nodding and gulping and talking about, the challenges of scaling in a very competitive category. We always hear that innovation is really important. And I kind of want to do a little true or false here with you, actually.
Yeah.
Jeff is actually consulting with and working with a lot of early stage brands right now, and I'm sure you get a lot of these questions. So why don't I ask you these questions on behalf of our audience and folks who are probably going to ask you them anyway. True or false, innovation is as important as ever to stand out?
True. Can I ad-lib something or not?
No, that's it. No, I'm just kidding. Go ahead. Yes, please continue. Elaborate.
If you look at interesting statistic in 2020, there was an average of 35,000 new products coming into the grocery channel, into the food and beverage channel every month. Now that's down to 5,000. So it's dropped 7 times in the last 5 years, the number of new products. And, retailers are still putting out new products. Just the money supply has dried up a bit, to help fund businesses to kind of have all that early stage innovation. And so I think if you're able to innovate today and bring products to the market, you've got, arguably maybe a little less competition than you had 4 or 5 years ago. I mean, you got a whole bunch of other things going on, but innovation is, like I said earlier, it's the fake it till you make it. If you are producing your own products, you need to use innovation as a core competency and a strength of yours, because you're going to have to spend more money on that plant, and you're not going to have the lowest cost to start. In the long run, you might, but you have to have other reasons to justify having that plant. Most of you are using co-man, which is the more cost-effective way. But if you aren't, and because you can't, we couldn't, so we had to make all of our own products. And having the ability to, if you do make your own products, you should have a model where you can launch a new product in 6 weeks. And that should be your mantra, because that's how you can take advantage of the asset that you have. If you don't have that, you're a co-man. Of course, you can't really do that. But innovation to me is the heartbeat of everything. It's also for me, the fun, the sizzle, trying to understand, how can I layer multiple need state benefits into a product? So it's not just an energy drink, it's an energy drink with immunity, or it's an energy drink with immunity with, zero sugar. So people that want, 1, then people that want 2, not want 3, they're kind of nesting those benefits. So all of a sudden you're kind of hitting instead of a 60% of the consumers that want that, you're kind of up to 90% because you've layered in these different need state benefits.
These damn investors, the money dries up because they want certain things. They want a path to profitability. I mean, crazy. We're living in crazy times, folks. But true or false, profitability should be top of mind for entrepreneurs.
I'm gonna say false, but and the reason I'm gonna say false is if you said gross margin should be top of mind for earlier stage entrepreneurs, I'd say yes, totally. Gross margin for me is, it's just super important. Getting yourself to a 40%, not on a product basis, but on a normal basis where you're looking at your trade spend being included in that and all that. Getting your gross profit to 40%, within your first, year or two is really important. And getting it to 50% within the first 3 years is really important. Profitability, you need to have profitability to sell the business. People don't expect you to make money in the beginning. They don't want you to lose $10 million a year. But if you're bouncing around, depending on the size of your business, of course, if you're bouncing around at $500,000 to $1 million of losses in each of the first couple of years, and then you start to get to break even, in year 3 or 4, and then you're starting to eat into that, that's a very, that's a fine model. Profitability is important, but you don't want to go if you don't feel like you have any money or ability to raise money. Of course, you got to take it slow and over a long period of time. But there are plenty of businesses, that have done that, really well. Jessica's business, Pop and Bottle, has done a really, really great job of, steadily and slowly building the business over the long term. And now they're a very significant middle market company. So you can do it without a lot of money, but most of us are raising money. The minute we raise $1, we're on the clock on that dollar. So we've got to be somewhat responsible to that. And what you do, the kiss of death are the down rounds, if you happen to do that with the investors, where you raise a subsequent round at a lower valuation, which causes a lot of agita for everybody.
So there you go. The next time you talk to an investor or potential investor and they say, I want to see profitability, be like, Jeff Church said, don't worry about that. Yeah. Gross margin is where you want to put your focus. That's what we're doing right now.
Let me tell you a quick story on Suja. I went back after the years, because we did 11 fundraising rounds in 9 years. I mean, you want to talk about, and as you do fundraising rounds towards the end, when they aren't expected, you literally feel like you're giving up a body part each time you do a fundraising round. So I'm walking around like this. But they're really challenging, to do. And I looked back and I said, what if, we had averaged the gross profit margin. Again, when you make your own products, you have higher costs to start. So we had averaged a gross profit of about 30% for the first 7 years. And I said, well, what if I had that at 40%? And over the 9 years, we raised about $110 million, and about 60 of that went into the manufacturing plants. And if we had been able to get the gross profit to 40% after the end of the second year, instead of raising $110 million, I would have only had to raise about $50 million.
Only $50 million?
Only $50 million. Yeah, sorry. But, I mean, it makes that much of a difference just by getting that gross profit up, just a little bit.
Nowadays, everything seems Instagrammable. Package design has come a long way from when I first started in the industry and seeing, version 1, version 2, version 3 until you get to that really glossy, beautiful package. And now it seems like it's table stakes. You got to come out of the gate with a great package. But I could be wrong. True or false, you need to invest in high-quality package design.
I think true on that one, for sure. I mean, you get... especially if you're going into a Costco, I mean, don't chintz on, the box. Make sure it looks attractive, because once you get in there, you want the product to turn. And, you see lots of stuff where people got a half-wrap tray in a Costco that, that's consumer-facing. If it's consumer-facing, it matters. If it's not consumer-facing, like you're shipping it to the retailer and then they're stocking the shelves and breaking the box or the half tray, then it doesn't need to look overly nice, but the cost of going, which is if it's a beverage product, for example, with a half tray that's white with your logo on it, it doesn't cost that much more than just a plain, corrugated tray. So you can make it look nice without necessarily all the bells and whistles. But again, I could come back to the fake it till you make it, and having that product look as good as it can be early on is really important. You can always bring those costs down, and those costs will plummet down once you get decent volume.
Our technical director told me I only have one more question, so
okay.
I'm going to make it this one. True or false? Now, for folks here in the audience, I'm sure this is an important question. Your first salaried hire should be in sales, a sales hire. True or false?
Generally true, especially when you realize all the paperwork you have to do. Unless you're really good at paperwork, you better get somebody, Jessica, on board that can do the paperwork for you, because God knows I would have gone down into a rabbit hole, never come out of it. But I do think, what I would say about hiring, though, is I strongly encourage you to use fractional people, early on. Fractional people are, consultants, but be really careful because they're a dime a dozen. But if you get the right ones, you get a skill set that's kind of been there, seen it, done it, and you don't have the full salary of that person. You don't get them full time, but you don't really need some of these positions full time early on. But I would think that you're either hiring a social media person or a salesperson probably first.
Folks listening to this podcast will wonder, how come you couldn't spend more time with Jeff Church? But you can spend more time with Jeff Church. You are, as I mentioned, consulting. Just quickly, talk a bit about your business and what you're doing right now. Yeah,
after I had my wonderful experience with Rowdy, I got a little gun shy, I have to admit. And I thought, I like this industry. How do I play in this industry where I don't necessarily have to have a brand? And what else do I like to do? I like to teach. I like to educate. I've got a godzillion mistakes that I've made and lessons learned. And, I began to think about creating an accelerator that would, be for earlier stage founders that would kind of, walk them through in a live setting. It's on a Zoom base, but we meet for about 13 weeks in the fall. There's two groups of 7 cohorts that we have right now going through. A few of the folks are in here tonight, which is awesome. And it's just really about, I'm bringing in speakers, so people like, you might know Mark Rampola of Zico, Seth from Honest, Seth Goldman from Honest Tea, Justin Prochnow from an FDA attorney. A lot of people that are really in the space that are kind of well known, and then I'm bringing these founders that aren't in competing spots and competing categories together. So there's a lot of sharing of information. I'm finding it really great. But as we started to get into it, I realized that 3 months of that might be drinking from a fire hydrant. So we created a boot camp. And the boot camp is really cool. It's self-narrated by me, but it's about 20 hours of narration that walks you through. I refer to it as kind of the MBA of CPG. It's not a 101 class. It's not a 401 class like you'd have in college. It's a 201. class, but it's got tons of information, and you can do the accelerator, which comes with the boot camp, or you can just do the boot camp. But if you're doing both, it gives you 6 months with me kind of mentoring you, and then you're in a group session, which kind of keeps the costs down. But I'm loving it. It's been a lot of fun, a lot of work to do, but I thank God for ChatGPT. But it's been a really great experience so far.
This has been a really great conversation. Jeff, I can't thank you enough for sitting down with me today and for sharing so much knowledge, insights, experience, the good and the bad with our audience today. Really appreciate it. Thank you again.
Thanks, Ray. Thanks,
Thank you.
everybody.